Good morning and welcome to our seminar on the financial reports for 2012 with updates through December 31st, 2012. We'd like to welcome those who are in the office today for the seminar, as well as those who are on the webinar presentation remotely at your own computers. Today we'll be discussing not only the financial update, some of the process and changes of the investment department, as well as the employer rates, employee rates, and discussing how that affects our actuarial reports. So with today, we want to welcome you, and we will take questions throughout the presentation today. Feel free to add those to the question box on the remote side, and if you have any here in the office, we'll entertain those questions as we go through our presentation. Today we wanted to talk a little bit about, first of all, what is the components of a public safety defined benefit plan. Right now we have about 38,000 non-retired members, and those are active members who are contributing to our plan. As you can see from that, there's about 14,270 retired members with normal beneficiaries and also disability retirements. So with that said, we do service about 53,000 employees in the Department of Corrections and Public Safety and elected officials throughout the state of Arizona. With that said, we do have a total plan for public safety. There's about 21,000, 18,000 contributing members and 1,400 in drop, and about 9,800 retired members. So if you were to break this down with CORP as well, we have some CORP attendees also today. It's about 16,000 active contributing members, if you will, and about 3,400 retired members receiving benefits at this time. And elected official, we're actually have exceeded the non-retirees, 977. We have more retirees than we do have active contributing members in the elected officials plan. If you look at the total plan statistics, we do have active members and contributing members versus retired members. If you look at the percentage for each of those in public safety, we have about 31% and only 17% on a ratio, and about 50%, as we just mentioned, in public safety, in elected officials. So you can see the elected officials is a very mature plan with more retirees, and public safety has about 31% as opposed to those contributing members, and CORP has about 17%, a much lower percentage. Because that all plays a factor in what we'll be discussing on the actuarial reports in just a few minutes. Let's take a look at how we did this last year on the revenue, expenses, and cash flow for our retirees, for our investment group this year. As you can see, the total revenue, most of the revenue came from employer contributions, about 380. Alternate contribution rates with the new law that was in effect brought in some additional revenue, some court fees for the elected officials. The employee contribution, you can see, is about half of what the employer contribution was, and also the service purchases and transfer was a portion of that as well. Now you can see the first box on the bottom left is the net investment. We actually lost money through our investments this last year, but we've turned that around for this fiscal year of 2013. Now on the revenue side, you can see the loss, as we said, on all the plans, which affected each one, public safety, CORP, and elected as well. The employer contributions were fairly consistent, and the alternate contribution rates you can see are broken down there, as well as the court fees that were applied to the elected officials plan, and the employee contributions, and the service purchase and transfers. So you can see this is a nice snapshot of really what happened with our total revenue for fiscal 2012 ending June 30th of last year. Now as far as the expenses, our total expenses was in the 701 range, but most of that you can see on the first bar graph went towards the normal retirements. The survivor benefits was the next largest one, then the disability benefits that were paid, as well as the premium subsidy, the drop benefits, the refunds, and a very small portion that went towards the administrative expense for those who work here in this office to support you in the field. But I just wanted to show you on this graph that you can see that most of the benefits went towards normal retirements for those who've retired and put in their time and service over the years. Now, as far as pension expenses totally, you can see for all three plans, broken down in public safety, CORP, and elected, the dollar amounts, and that's kind of a good snapshot of actually what happened for this last year as far as the expenses. But as you can see again, most of the money went towards benefits paid to those who've put in their 20 years or 25 years of service. Now, if you were to graph this on a different, you can see the net cash flow over the period of time from 2000 up to 2007 was a kind of, we're running in a negative cash flow position with revenue and expenses against those two prior slides that we just showed you. Now, I wanted to go back and give you a little example from June 30th of 2006. You could see our market. We had most of our investments in stocks, as you can see, and bonds, a little bit of real estate, and a little bit of cash. Our investment team has, over the years, decided to change that, and I wanted to show you a new asset allocation for our investments going forward. So you can see 70% stocks and 21% bonds. Now, if you look at the next slide, you'll be able to see how that's changed, and our asset allocation ending June 30th of 2012 is much different. We had about $6.6 billion in assets that we've been investing in, and you can see the U.S. equities is about 19%, non-U.S. equities is around 14%, and fixed income is about 13%, real estate's 12%, there's credit opportunities, real estate, private equity, and other, we'll call them buckets at this time, so we can diversify the portfolio, so if we have any market swings within the stock market, we're not affected just the way the direction the stock market goes. So as you can see, over a 5 or 6 year period, we've actually changed our investment strategy to have a different asset allocation going forward. Now, what does that do to our rates and returns and funding levels within the plan? It has a large effect on that, and let's take a look at some of that. The total fund rates, as you can see, gross of fees for 2012, if you look down the column, on the monthly column, you can see we're running fairly negative and positive as the year goes on. But if you look at the fiscal year-to-date column, we ended up with a negative 0.32%. Last year, in 2012, was a more difficult year. Our benchmark was around 2.89%, as you can see from the slide here today. So as we go into the new year of 2013, we've changed those policies quite a bit, because our net of fees was a negative 0.79%. We missed our benchmark, so we actually underperformed by negative 3.68%. You can see all the contributing factors for each of these categories, and the total underperformance is at the bottom, as you can see. But all the diversification worked well in 2011 because we had a 17% return. Did not do as well in 2012, but did much better in 2013. Here's an example of our total fund rates of return so far for 2013. Starting July 1st, you can see we had a positive return in July, August, September, October, and October was a negative all the way up through December. I wanted to highlight that we are up 6% of our fiscal year-to-date returns so far for this year, and we are beating the benchmark at 5.43%. This just shows our asset allocation is doing well this year and will continue with that performance. We had a great performance in January as well. So you might ask, why do we have asset allocation? Why do we want to diversify the portfolio here? Well, you can see that there's a range for the equity markets, the non-U.S. equity, All of these different categories we were just talking about has a certain amount of dollars invested in each of those, and they're in very conservative investments at this time. Now the total fund performance, as you can see, for last year was a negative return, but for a 3-year period we had a 10% return, and a 5-year return was about 0.48% because of the losses in 2007 and 2008. So what we wanted to talk a little bit about is these performances and how that affects against public safety. So you can see that if we're not beating the benchmark, then we're actually losing, obviously, money in a given year over a 1-year, a 3-year, a 5-year period. So we're going to continue to work with our investment team. We'll continue to work with the best investments possible. Our investment portfolio returns, as you can see, on a 1-year was a negative 0.7, positive on a 3-year, which is very good, a 9% return, we thought, a 5-year 0.5, but on a 10-year average, net of fees, has been 5.5%. And we did beat the benchmark at a 3.91%, and very closely behind ASRS, but ahead of CORPers, some of our local groups here as well, here in Arizona. So I just wanted to show that over a 10-year period it's been about a 5.5%. Now if you look at the total fund and the benchmark, it's interesting how this has worked over the years. We had some losses in 2001 and 2002. You can see it's been very positive in 2003, 4, 5, and 6, and 7. Then we had a hiccup in the market in 2008, 2009. Very positive returns in 2010, 13%, as we changed our asset allocation. In 2011 was very good as well, but we were down just a little in 2012. Now what does that do to our funding level over that period of time? If you go back to 2005, you can see public safety was at 83% funded and has declined over the years to 2012 to 58%. CORP was funded at 101%. In other words, we had more assets than we did have liabilities at that time, or equal. And now we're down to 67% funded for CORP. So you might ask yourself, what does that do to the employer rates as it moves forward? Well, let me explain that to you for a minute. If you look at the contribution rates for both the employers and the members, you'll see a definite trend of it moving upward. Let's take a look at that for right now. The aggregate employer rates over a period of time for public safety used to be 10 years ago in 2002 3.75%, and it was moved up over the period of time as high as now in 2013 up to 30%. So you can see that we have more retirees that we're paying out of the system, which we call liabilities in this situation, than we do have assets or income coming in from the contributing members. That is one of the reasons why our major increase of employer rates moving up. If you look at the member contribution rates, they were steady at 7.65% in 2002. And as you look across the chart, they started moving forward and moving up in 2011 with the recent changes of Senate Bill 1609 to 8.65%, 9.5%, and the employee rate will be at 10.35, moving up to 11.65 in 2015. So you can definitely see an upward trend in both the contribution rates for the member as well as the employer. And this also holds true for the contribution rates for a corrections officer plan as well. The dramatic increase going from 2003, the rate was at 3.95%. The employers were not paying very much in. But as you can see, that's been moved up to this last year of 9.5 and 11.35%, 3.1%, up to 13.68%. So you're seeing a definite increase in the employer rates for the corrections officer plan. We also look at the member contribution rates for that period of time as well. They've been pretty steady around the 8.5%, and the employee rates are now around 8.4% for officers and about 7.96 for dispatchers. So the same is holding true for the elected officials plan. The employer rates is definitely skyrocketed from around 13% up to 39% this next year, which is a tremendous increase. And again, that's one of the reasons is because we have more retired elected officials members than we do contributing members in that plan. Therefore, also the member contribution rates for EORP has gone from around 7%, and it's recently moved up to 10%, 11, 13% going forward. So that's the trend of what's happening with the employer and the employee contribution rates up to this point. Now we also have the alternate contribution rates if somebody has come back to work in a return to work situation. Those rates, as you can see, for public safety is 8%, and they'll be moved up to the 10.51%. Next year it'll be at 14.57%, and we're moving up to the 17%. And that's all according to what the law, Senate Bill 1609, introduced. CORP has stayed pretty steady at 6%, going up to 6.18%, and EORP is around 10, and it'll be moving up to close to 21%, as you can see from the chart here. Now you might ask yourself, what questions do you have from all the information we've presented so far today about member contribution rates, employer rates, the state of the financial condition of the investments? Okay, we do have one question. Let's go ahead and take that question. What is the status of the lawsuit of the member contribution rate? Right now it's in the court system and it's still being determined what that's going to hold. We don't see any outcome from that recently in any information we've received here in the office. So at this point we really cannot comment on it other than it's still going through the process. How long will it be before PSPRS will have more retirees and employees? As you can see from the previous chart, it's growing at the rate of almost a certain percentage each year. I think it'll be not too long future that it'll be about the same, where you'll have, it's a mature plan. It also depends on how many will pass away during that period of time, but I think we're moving in that direction. It may be a few years before we get there. Thank you for those questions. We'll go ahead and proceed at this point then. So we'd like to take a little bit about the plan changes in the financial status. Now you've kind of got the numbers behind what's happened here at Public Safety. So a changing of financial status is definitely one of the reasons why the employer rates have gone up. And let me explain how that happens. If you run your eyes across 2012, we'll just say the actuarial funded ratio was around 115%. In other words, the assets we had was around $5 billion, and the liabilities was around $5 billion. You can see that for 2002 and 2003. Now, if you run your eyes down the chart from all the way on the liability side, you can see the liabilities have grown and doubled in a 10-year period. Does everybody see that? So in other words, we've had more retirees leaving the plan, and that's one of the reasons why the liabilities have grown, because that's where the majority of the money is being paid towards. So in 2012, we were at 60% funded versus our actual asset value is at $7 billion, and as we mentioned, we have exactly $6.65 billion. Okay, so we're at the 60% funding level for 2012 for the total fund. Now, if we take a look at that and look at it for just public safety, the same holds true. If you go back to 2002, in a 10-year period, our actuarial liabilities was about $4.7 billion, or to $4.1 billion, and see how it's grown to 2010. It doubled by the time it got to 2010. In other words, in 2012, we're paying out $10 billion on an actuarial liabilities side, where we only have in public safety about $6 billion to make those payments. So you can see it's down to about a 58% funding level for public safety. Now, hopefully you can see from this example that when your liabilities grow at that exponential rate of doubling in a 10-year period, that means you're paying out more benefits in a period of time, and the actual assets have not grown in the same direction as the liabilities have. The same is true with CORP. If you look at, we'll just go back to a 10-year period of where it was 123% funded, and if you go down to 2012, it's 67% funded. In other words, the assets are at $1 billion and the liabilities, at $2 billion. So I just wanted to give this as an example of what's happened when a mature plan over since 1968. There's more retirees moving that direction, and not as many contributing members. The same holds true with elected officials. We're 125% funded, and they're down to about 58.4% funded. So if you look at those numbers, you might say if your assets aren't growing as fast as your liabilities, then some changes need to be made. So some implications for the future we've outlined here. One of those implications is we were paying out a lot in the post-retirement adjustment balances over the years, or the COLA increases. So you can see in public safety the reserves in 2008 and what the cost and the balance was. As you can see, we were paying out quite a bit of money over a period of time. Now in 2012, we paid out about $167 million, and that's all taken up all the money in the reserve account. In 2011 was the last time we paid a COLA increase, same with the elected officials. So you can see there was a cost and a balance, and all of that added to the liabilities on the previous figures that we were just looking at before. So hopefully that kind of gives you an implication of because of the COLA increases also and the number of retirees, that's why the liabilities have grown so much over the years. So the Board of Trustees has said we need to have some funding goals to bring that back. And we want to return all three plans, public safety, CORP, and elected, to an 80% funding status or better. That's what our goal is. Right now we're in around the 60% funding level. We want to have a 75% or higher probability of achieving this goal within a 10 to 20 year period. And that was one of the reasons why there were changes made back into the Senate Bill 1609. The experience study of a 5-year study based off of June 30th of the year before, 2011, definitely made an impact on the direction the fund is going. Because they were saying, the actuaries were saying, that the employer normal cost is running around 12%, with you amortizing that, bringing it up to about 27%. But if you look at the revised demographics, we used to have an assumed earnings rate of 8.25%, and many of you know that it was moved to 8%, then it was moved to about 7.85%. So if you look at the second column from the right, you'll be able to see that that's about what the funding level, or the amortization and the total employer contribution rates are based off, is about that 30%. Same with the funding status for the accrued liabilities, and the funding ratios around that 58%. So each time the the assumed earnings rate is lowered, as you can see, of 8% or 7.5% or 7.75% or 7.5%, it actually increases the employer rate. You see the correlation between those two? And hopefully the funding level will also then be able to turn around. The same thing happened with CORP. As you can see, it's running around the 7.75%, with the second part of that is the salary growth rate of 4.5%, And this is what the Board of Trustees used as far as the actuarial information that was presented to them. Also, that's true with the elected officials. You can see that they're around 60% funded or less, and their rates are running around the 39–40% of payroll. So any questions about this at this point? So we wanted to just give you the correlation between the assumed earnings rate and also the rate of return that we've talked about. Will the projected 1/3 and 2/3 split for the employee and the employer contribution rate apply by district or by overall plan? Okay, let me explain that for just a second. What happens is each individual group has their own employer rates based off of the contributing members that they have, as well as the liabilities they have within their own plan. So what we're giving you is the overall rates, and we're going to get into individually the employer rates for each fire district. Each employer group has its own set of contribution rates. So yours might be only around 12 to 15%, but some of the larger employers are running the 35 and 40%, and that's why the average is a little bit higher. Hopefully that answers your question. So let's go through a few frequently asked questions that always come up. If we could for just a minute. You want to buzz Lori real quick? Oftentimes what happens is we have questions about each individual employer contribution rates. And some of these questions come up and we wanted to go over those for a few minutes now that you've seen the financial condition, the employer rates, and how those are all affected. Where can I actually find these employer contribution rates for the next fiscal year? This is a great question. We want to take a few minutes and discuss this. Also, why is the employer contribution rate so high? That's one we were just talking about. Why is it in that 30, 35, 40% range? And what affects my employer contribution rate? So each individual employer group has its own rates. It's not affected by everyone else. And why do I have different rates for our police group and for our fire group? I think that's a great question as well. So let's take each one of those individually for just a minute. Let's take the first one. If you were to open up your actuarial report, you'll be able to see where do I find this information. This is located at PSPRS.com, and you can actually pull up all the employer rates or the consolidated rates as well. So if you were to pull up your employer actuarial report that should be discussed in your local board meetings, the answer to this question is the employer contribution rate is always found usually on Section A, page 2 of your individual valuation under contribution requirements. If you look at the last line in the table, the minimum contribution rate is what you will be asked to pay that next following year. So if you were to look at the ABC Police Department on your actuarial report for maybe example 2011 for your fiscal contribution rate of 2013, there's a normal cost of around 13%. You'll have additional service purchase pensions, disability pensions, and other things that are factored in there of around 19%. Now the employee contribution rate, remember this last year for this example, would be 9.5%, plus your other things that affect that, bringing the total up to around 20%. But also because of the health costs, you would need to look at the subsidy would add about 1% to that. So your minimum contribution rate is around 21% as an employer. Now this is what the actuaries do for you every year. So we always encourage you to look at your actuarial reports, know where those rates come from, and you can see in Section A, page 2, that is given to each individual employer every year. And we post those on the website so you can pull those up and see how many contributing members you have, as well as how many retirees you have, and what your liabilities are on an individual basis. All the numbers we gave to you are all of the collective data that we have for all the public safety groups, and they're rolled together, but yours are individually calculated. So I think the question always comes up, why is my employer contribution rate so high? This comes up year after year. The answer to this, as we just looked at, is the employer contribution rate is figured from a number of factors. If you had more retirees than active members that year, your rates are going to go up because you're paying out more in pension benefits than you took in from your active members contributing. So the difference needs to be made up in order to preserve the funding status that we were just talking about. So in this situation, your normal cost is around 20%, and your employee contribution rates is around 13%, we'll say, with everything factored in. And if you add that together, the total pension amount would be 129% plus the health costs. So in other words, in this particular plan, XYZ Police Department, they had more retirees than they did contributing members. They're a very mature state, and they're paying more into the system. Can you imagine paying 136% of your salary payroll? Some of the employers are having a very difficult time doing this right now. So that kind of ties into the previous question, is how do you find your rate? Hopefully your rate's in the 10, 15, 20% or lower. When it gets up this high to 130% of payroll, you have a lot of money that needs to be set aside for your contribution rates, because you have more contributing members than you have more retirees than you have contributing members. So let's take another discussion about what affects these employer contribution rate. The answer is, in general, a lot of things do, but let's take a look at some specifics. If you have more retirees than active members, your employer rate may go up, may be a little bit higher. That's what's happening with a lot of the plans, individual employer groups right now. The second thing is if you have more new employees with less credited service, your employee rate may go down because you're making more contributions into the system than you are having paid out to the beneficiaries. Also, when you hire a new employee, your employer contribution rate could increase or decrease depending on if they brought over prior service with them from another employer. So if you brought somebody over with 10 years of service, then your rate may go up because they are getting closer to their retirement date. So there's a lot of things that affect the employer contribution rate. These are just some of the more general ones, but the specific ones also, as we talked about, depending on how many retirees you have, is going to definitely affect your rate. Now, another one is if you have a larger number of accidental disability pensions that you've approved for your group in a past fiscal year, your employer rate may increase as well, because that individual did not make it to a 20-year retirement, maybe only worked 8 years, you approved an accidental disability, you've lost 12 years of contribution. Therefore, the actuaries look at that as your rates may go up to pay for that. So the whole group will pay for that as a whole. So these are some of the reasons that may affect your employer contribution rate as well. I think another question always comes up is, why do I have different rates for fire and police groups? Maybe you're a city, whatever city it might be, and they say, well, they're only paying 20% and we're paying 14%. What is the difference? Let's take a look at that. The factors which contribute to each employer contribution rate has into effect the membership, the credited service, and the number of retirees. That's the major factor that are contributed on an actuarial report. If they're different between the two groups, therefore your resulting calculation will be different as well. Therefore, maybe your police group has 50 contributing members and only 12 of them have retired. Maybe your fire group has 100 contributing members and 70 of them are retired. Obviously, that would make a big difference because the membership, credited service, and number of retirees are different for both the plans, even though you're in the same city. So it's individually calculated and given to each employer group every year. So we want to thank you today for attending so you get an idea, and we want to take some additional questions at this point. What is the likelihood that the investment results in the future can meet the actual assumption of 7.85%? I think this year we'll have a very good chance of meeting the actuarial assumed rate of 7.85%. As we discussed in the presentation so far, for the first 6 months we're up to 6% already. So I believe we'll be able to hit the 7.85%, but we don't see the unforeseen circumstances that will happen in the next 5 months before our June 30th close. That would be the qualifying statement. If there's a geopolitical disaster somewhere in the nations around the world. Okay, how long before the new changes begin to reverse the trend? Actually, I think we'll be able to see the changes from Senate Bill 1609 have already changed, or will reverse some of the changes in the trends that we've had in the past. Because as you understand, Senate Bill 1609 has more contributing members now, and they have to stay for 25 years versus a 20-year retirement plan. And the actuaries will be able to factor that in as we move forward. So I believe that the trend will continue to change as we continue to make our conservative investments with the investment team, and hopefully produce that 7, 8, 9, 10% over an average of a 10-year period. That's what our goal is. That will definitely help out with the employer contributions as well. But as more retirees retire, we have to continue making the payments, and that does drive up the costs for the employers in each individual situation. Will PSPRS pursue changes for Tier 1 employees? We will not pursue any changes, but the legislature or the constituent groups may look for changes going forward. But at this point, we're very neutral and moving forward with plan changes from 2 years ago that the law infected in Senate Bill 1609. We would never move forward with any changes that we can see, but we never know what will happen down at the legislature in a given year. So we wanted to give you some contacts here. Myself, Don Minear, Robert Ortega, LaDon Toger is our active members department supervisor or manager, and any online resources that you have, you're welcome to go to that as well. We appreciate your attendance today, and thank you for attending, and feel free to contact me individually if you'd like to at the above email address or phone number. Thanks for coming in, and hopefully this has answered some of your questions. Thank you. Bye-bye now.